Welcome, everyone, and thank you for joining us today. We are so grateful that you're here, especially during filing season when time is tight and your focus is on supporting taxpayers and volunteers. We're really grateful to have you here for this Tax Opportunity Network filing season kickoff. And we know filing season brings both opportunity and complexity. Many of you are navigating new requirements, new conversations, and continued demand from the communities that you serve. We've designed today's session to create space for shared insights, questions, and real-time learning together. We're very glad to gather this community of practitioners, partners, funders, and advocates to kick off this filing season together. I'm Sarah Bacerra, and I serve as the Interim Chief Program Officer at Prosperity Now, where I oversee our program strategy and national networks, including the Tax Opportunity Network. Much of our programmatic work at Prosperity Now is focused on supporting practitioner communities, making sure we're learning from the field, elevating what's working, and connecting to resources that connect to real world implementation. As a container for how we'll use our time together. A few quick notes before we jump into today's content. Throughout our session, please use the chat to share reflections or examples from your work. We'll elevate and amplify these themes as we go. We also want to encourage you to drop questions into the Q&A at any point. We'll be keeping an eye on that and respond throughout and also reserve time toward the end for some moderated discussion. We'll also incorporate a couple of quick polls throughout the session to hear what's top of mind for you. This session is being recorded and we'll share the recording and follow-up materials after. This is also meant to be interactive, not a one-way presentation. We have phenomenal speakers, we have phenomenal topics, and amazing practitioners in our session today. So we want to make sure that we elevate all voices in our conversation as we go. With that, before we jump into content, we'd love to get a sense of who's in the room today. In a moment, you'll see a poll pop up on your screen and select the best option that reflects your role during filing season. You can see those options: partnership, are you a tax site, are you a funder, supporter, volunteer, can go under that VITA TCE supporter. Take a moment to let those responses come in. Slowing down, we'll take about 5 more seconds. Keep those coming in. All right, looks like we've got a bit of a slowdown and we are ready to share a little bit more about who is in the mix today. So we've got almost half of us connected to tax sites in some way. We've got funders in the room, supporters in the room, as well as partners. It's always helpful to see the mix of your role and how it relates to our conversation. It's great to see so many of you and leverage these different perspectives as we understand what you're navigating now. We've got one more poll before we jump into today's agenda. So we know there's a lot happening. There's a lot that we are all collectively navigating, a lot of different changes. So as you're thinking about this tax season, what's your biggest concern? You'll see those options in the chat. Is it new laws? Are you having volunteer management be a big area of focus right now? Is it research development? We're going to talk a bit later about 530A accounts, Trump accounts, what's going on in terms of planning and strategy. So I'll give everyone a moment to share where you're at today. All right, I think we're ready to share this one. So we can see our primary biggest concern is new tax laws. A lot of changes. I'm going to talk a little bit later about some resources and ongoing support as it comes to these new laws and disseminating information. 65% of us, though, are really looking at what do we do? How do we adapt? How do we educate? Volunteer management being that second one, certainly about a fifth of us are looking at that, maintaining capacity or growing capacity as needed. Resource development and also 530A accounts, a little bit smaller, but certainly top of mind. Thank you for sharing a little bit more about where you're at today. Again, there will be lots of opportunities to connect on what you're seeing, some direct questions for our panelists and for our conversation topics today. So I'm going to move us into a quick overview of the Tax Opportunity Network, a national community of practice focused on connecting organizations working across tax time services. If you've joined a previous webinar as a Tax Opportunity Network partner, you'll know that our aims are to expand access to no-cost trusted tax preparation, share those practical tools, training, and updates. As we know, there's some of that here, and there's certainly going to be more to continue our conversations outside of this session. Learn from peers across programs, regions, and roles, and then strengthen coordination and consistency across the field. Tax Opportunity Network aims to bring together practitioners, partners, and stakeholders, as we are today, who support tax time services in a multitude of ways: direct service, coordination, training, outreach, and systems level work. So again, we are so grateful that you are here and able to join us today. Let's talk briefly about where we're headed and how we'll use our time together. First, we'll start with what's new this filing season, and I'll turn it over to Sarah Castro and Rebecca Thompson, who will walk us through key tax law updates, highlights from VITA Train 2026, what's new, and practical considerations for advanced returns. Next, we'll move into 530A accounts and household financial stability, where Madeline Brown Urban Institute will provide context on how these accounts work, what eligibility looks like, and how partners may think about local engagement and outreach. Then we'll shift to taxpayer rights and protections, and we'll be joined by Nina Olson, who will ground us in taxpayer rights most relevant during filing season, common challenges practitioners are seeing, and what steps are available when issues arise. Then we'll pause for Q&A, pulling questions from the chat and Q&A box, so keep those coming in. And finally, we'll close with ongoing resources and staying connected, where I will close us out sharing follow-up materials, opportunities for field learning, and ways to stay engaged through the Prosperity Action Network. We're going to keep this session very focused and practical, and we're looking forward to hearing your reflections throughout. With that, we'll start our conversation around what's new this filing season. As we look at what comes up in terms of changes, knowing that new tax laws, our 65% of us are concerned about these new tax laws, this module and the overarching VITA Train curriculum really help to highlight different changes, walking through new deductions and reporting updates, flagging areas that may require proactive conversations. And it's designed to support volunteers and site coordinators in preparing for common scenarios. This is available on Prosperity Action Network. And in a moment, we'll share those links to join the Prosperity Action Network, which is also a platform to give you access to a wide breadth of tax time tools and learnings. And signing up for that platform will get you access to, as new information is coming out, updates and any additions that come as new information is discovered. So that link is now shared in the chat. Thank you, Rebecca. And we just want to shout out again all of the volunteers that really stewarded making these updates happen, updating the curriculum, making sure this real-time information and trusted information is provided as volunteers need it. So we certainly have time and opportunity for questions around the content, and I'm going to pass it over in a moment to our experts in this area. And I'm going to start with Sarah Castro. So in a moment, we're going to hear both from Sarah and Rebecca. I'm going to share just a little bit about each of them before I pass the mic over. Sarah Castro is the Senior Impact Manager for United Way of San Diego County. where she leads SparkPoint, a county-wide financial coaching initiative. With over 20 years in the nonprofit sector, she has expanded access to financial services for underserved communities and built volunteer income tax assistant programs in multiple states. She also serves on the National Tax Opportunity Network Steering Committee, so we get to work together a lot. Let me share a little bit more about Rebecca Thompson as well. She's an economic justice consultant and longtime advocate for equitable tax policy and no-cost tax preparation programs. She also works closely with the Tax Opportunity Network on the steering committee to support practitioners, strengthen VITA initiatives, and elevate field insights into broader policy and systems conversations. Rebecca brings extensive experience in tax credit, outreach, coalition building, and advancing strategies that expand access to tax time resources for low and moderate income households. I am so grateful to have you both here. Sarah and Rebecca, I will pass it over to you to talk about tax law changes and what's new in 2026. Thank you, Sarah.
Thank you, Sarah. Thank you for that warm introduction and for the opportunity to present today. I'm really excited. I'm very grateful to have been part of the TON Steering Committee over the last several years and can attest to the value the network brings both to local programs and to the community tax preparation field nationally. I want to take a few minutes, as you said, to highlight some of the key tax law changes that some of you are seeing in the field. So first, I want to also say that the information shared can be found in the What's New module of the VITA train on the Prosperity Action Network. The following tax law changes are only applicable to advanced level returns. It is important to note that there were no tax law changes to basic level returns. So let's start with the Schedule A itemized deductions. Since the standard deduction has increased significantly over the last several years, VITA clients typically take the standard deduction. You can find the dollar value of the standard deduction for each filing status, along with the rest of the information we'll cover in this segment, in the What's New module in the Prosperity Action Network. For those clients who do have enough deductions to itemize, there are a few significant changes to the Schedule A that are more likely to be relevant to VITA and TCE clients and returns which we want to call out here. First, the state and local tax deduction, which includes property taxes, is increased to $40,000 for married filing jointly or $20,000 for married filing separately and all other filing statuses. Also, the mortgage insurance premiums deduction, also known as PMI deduction, is now permanent. Moving on to self-employed and gig economy workers, the threshold for when third-party settlement organizations are required to send 1099-K has increased to when a taxpayer receives more than $20,000 in payments and more than 200 transactions in a year. Many third-party settlement organizations will send out 1099-Ks to taxpayers receiving less than $20,000 in payments, particularly for Uber and Lyft drivers. If you've been around the tax preparation community for any length of time leading up to this tax season, you know that new no tax on tips and no tax on qualified overtime provisions are a big deal. We're seeing and hearing the good news that although it is not a requirement for this year, a lot of employers are reporting overtime premiums in box 14 of the W-2. It is important for volunteers to make sure they're entering the data exactly as it appears on the W-2. Tips have always been reported on the W-2. It is important to ask taxpayers if they had any unreported tips. If they received tips they did not report to their employer, it should be reported on Form 4137. And as a reminder, all income must be reported. Finally, some taxpayers may have purchased a new car in 2025, which may make them eligible to claim the new car loan interest deduction. Among others, there are two key points to highlight for eligibility for this deduction. First, it must be a new car, used or not eligible. And second, the final assembly of the new car must have been in the United States. Now I'm going to pass it over to Rebecca to talk about important conversations to have with taxpayers this filing season. Thank you.
Thank you, Sarah, and good afternoon, everyone. It is great to see so many familiar names and faces here on the webinar today. So beyond most of the the most common tax law changes impacting low to moderate income taxpayers that we need to be aware of, there are some conversations that we should be prepared to have with taxpayers and other topics that we should be addressing while we have their attention that will, in some instances, prepare them for the 2027 filing season. So, often taxpayers have work done on their homes throughout the course of the year with the intention and the hope and the expectation that they will be able to claim a tax credit for a portion of their expenditure to improve their residence. So, one of the things that we should be prepared to make taxpayers aware of is that the residential energy credits that are claimed on Form 5695 will expire after 2025. So, they will no longer be applicable for any work that they have done this year. Also to note is that a 4-digit qualified manufacturer identification number may be required to claim the credit on this year's tax return for certain property that was placed in service in 2025. And we also know that healthcare subsidies have changed significantly over the last several months as prices have drastically increased. It is important to note to taxpayers who have health insurance through the marketplace that 2025 will be the last year that repayment caps will be in place if a taxpayer has underestimated their income. So it's important to note to folks that there will no longer be that cap. And so if they continue with marketplace insurance, that they may have to pay back all of any excess subsidies that they received. Now, the majority of our VITA and TCE clients do receive their refund by direct deposit, but there are still those who don't have a bank account or who would just prefer paper check. So we all know the IRS is implementing Executive Order 14247 to phase out the refund distribution by paper check. So for returns where the taxpayer is receiving a refund, but no direct deposit information is provided, the taxpayer should be advised that they may have to wait 6 weeks or more to receive a paper check. Now, the IRS has updated their procedure for processing refunds without direct deposit information. So once that return is processed and there's no direct deposit information on it, the taxpayer will receive a CP53E notice in the mail requesting response within 30 days, either to provide the banking information or to explain why such information cannot be provided. Also, there's the Where's My Refund tool on irs.gov. That will provide messaging related to the need for banking information as well. The taxpayer will be able to use the IRS individual online account to provide their information. I'm a big promoter to make sure that everybody's got that individual online account. So that is a great place if folks don't have a bank account right now, but they can go on a little later and provide that information as well. It is also important to note that for security reasons, IRS employees cannot take direct deposit information over the phone. So there is no need to call and try to give that information to an IRS employee. What we can do right now is that this is a great time for partners to encourage direct deposit. It's a great time for partners to establish or revitalize relationships with the local financial institutions. Join a bank-on coalition if you're not already part of one. Also, don't forget about the alternative depository account options like Cash App, Venmo, PayPal, and others where taxpayers may be able to receive their refund. Not to sound like a broken record, but we know direct deposit is still the fastest, safest way to receive a tax refund. And finally, taxpayers will now have the option to submit information to open a 530A Trump account for children under 18. This is a great opportunity to plant a seed to build wealth for children that are born in historically marginalized and underserved communities. So our next speaker, Madeline, is going to talk in depth about the logistics and mechanics of these accounts. But it is important to know that the Form 4547 to open the 530A account is available in TaxSlayer. I've already started telling expectant parents about this opportunity, so I hope that you will too. And with that, I'm going to pass the mic to Madeline.
I'm going to give Madeline an introduction. Thank you, Rebecca and Sarah. That was a fantastic in-depth overview of what's new, how we're having these conversations differently, and feeding directly into our next conversation and insight opportunity from Madeline. In in this conversation, I do want to take just a second for one other, not other, we've got another one, another poll around partnership. So at Prosperity Now, our core values are innovation, purpose, and partnership. We cannot do what we do without your organizations helping households learn about tax time savings opportunities. And so, in a moment, and right now, actually, we'd love to hear which are some local partners that are really relevant to your tax time work. As we're having these conversations about new tax laws, about the topic that Madeline's about to cover in terms of 530A accounts and household financial stability, who's helping you? How are you supporting one another? The other ask here for just a moment, and the chat is now enabled, so feel free to start those comments coming in the chat. In addition to this poll, share one local partner that your organization already works with or would consider working with to help households learn about tax time savings options. We'll hear from you and then we'll pass it over to Madeline. Lots of responses coming in. We'll give just a few more seconds for this poll to wrap up. Feel free in the chat to share those partners. Thank you, Luann. Local libraries. Fantastic. United Way. We just heard from Sarah, who's part of United Way of San Diego County. We love United Way. Keep those coming in. And I will, nope, we still got a few more responses coming in on the poll. All right, I'm going to pause our polling and share where we are landing today with overwhelmingly, certainly, community-based nonprofits. And you had the option to choose multiple, so I'm sure there is definite overlap between working with these nonprofits, financial institutions, or credit unions, and as a close second, housing or housing counseling organizations, employers and schools, employers, workforce organizations, schools tied at 17%, and some fantastic local partners being amplified and elevated in the chat. Thank you for sharing a little bit about what partnership looks like for you today. I'm going to stop sharing that poll and transition us into our next very timely topic today from Madeline. So, Madeline, we are so grateful to have you here today. Madeline is the Senior Policy Associate, part of the Research to Action Lab at Urban Institute. And it's here that she advances equity in public policy. So, one, we're very, very happy for your focus. And a little bit more about Madeline's background. She previously served as a senior policy advisor at the U.S. Treasury, helping develop a federal wealth building agenda. She's a leading expert on baby bonds and early wealth building. And she leads national research and modeling efforts to assess their impact. So, there is wonderful opportunity here to elevate the work that you're doing, Madeline, every day, boots on the ground, and we're so, so happy to have you here. So with that, I will pass it over to you.
Thanks, Sarah. Hi, everyone. It's great to be with you today. I appreciate you having me. I'm going to start with just kind of nuts and bolts of these 530A Trump accounts, and then I'll offer some thoughts on sort of why outreach and education are so important. I'll try to keep an eye on the chat as we go, but please feel free to jump in with questions too. All right, we can hop to the next slide. So just some key design features. Section 530A introduces a modified IRA structure. So these Trump accounts are essentially an IRA without an earned income requirement, which allows you to open one for a child. They must be invested in an eligible investment. So this is a mutual fund or an ETF that tracks sort of qualified index. Once the child reaches 18, the account can be invested like any other traditional IRA. One important thing to note about these accounts is the trustees, so the financial institutions who are going to be managing them have not yet been announced. We are expecting that from Treasury soon. We expect one, maybe two financial institutions to be selected initially. Families can make after-tax contributions into these accounts, not to exceed $5,000 annually. Employers can also contribute up to $2,500 a year. That does count towards the $5,000 limit. And then cities, states, tribal governments, and nonprofits can also contribute unlimited pre-tax funds, though there are some stipulations around the groups of kids that they can give to. And this is to try to avoid high income gifts in specific geographic areas. But currently, regulations say that beneficiaries all have to be under 18 within a certain geographic area that has at least 5,000 beneficiaries or represent a whole birth year cohort. And then the contribution per kid has to be at least $25. So this is leaving mostly larger nonprofits, cities, states, just given the sort of numbers here in terms of the gifts. We can on to the next slide. Awesome. Okay, so again, the tax code creates this sort of new type of IRA. The legislation over the summer also created this pilot program. So babies born between 2025 and 2028 are eligible for a $1,000 gift from the federal government into their Trump account. The children have to be U.S. citizens with a Social Security number. And the form, and we'll talk about this a little bit more in a second, Form 4547, is also asking for parental Social Security numbers. Other children are also eligible for contributions into their accounts. You may have heard that the Dell family is giving $6.25 billion into these accounts. So that is going to be the first 25 million children aged 10 and under who live in zip codes where the median income is below 150,000 will receive an additional 250 or an initial 250. And then there's a couple state efforts. Ray and Barbara Dalio in Connecticut will give 250 to 300,000 kids there. Brad Gerstner of Invest America will give a sort of undetermined amount so far to kids under 5 in his home state of Indiana. And then there are nearly 36 companies so far who have pledged to either match the federal contribution or match their employee contributions. A handful of these are shown on the right. So I think the point here is there are lots of kids, not just this pilot cohort, who are actually going to be eligible for some gift into their account without their parents having to contribute, though they do need to open their accounts. So let's go to the next slide so we can talk through how that happens. Awesome. So enrollment, it is now tax season, as you all know. Parents can sign up using Form 4547. It is live. It looks like this on the right. There's a couple things I want to point out to you. First of all, that parental Social Security number is that first highlighted box on the right. Again, this was not legislated. It is in this form. If you look at the instructions PDF for the form, it says that parental Social Security number is not required, though a failure to include one may result in a delay of processing. It also states that an ITIN can be used in the place of a Social Security number, though it also may delay the processing. I think this is important because A, it's not required technically by the legislation, and B, we do know that this might chill, especially for mixed status families, some enrollment in this program. So we're keeping track of this and paying close attention. The other important thing on this form is that it is a two-step process. So you can see in part 2, that's where you enter your child's information, and that just actually creates the account. Part 3 is where if you have a child who's eligible for that $1,000 gift, you actually have to go ahead and check that second box. So I do think it's important for folks to know this is a two-step. You have to fill out both parts of this form. Non-filers are going to be able to use trumpaccounts.gov. We don't know what that form is going to look like yet. We expect it will go live this summer, but there is a sort of non-tax form way to enroll, but we just don't know much about that yet. And then for everybody, even if accounts are open now via the tax season, no money is going to be deposited until the summer when the accounts sort of officially go live. All right, next slide. Awesome. So just tax treatment at withdrawal for you all, since you will be paying attention to this. So no distributions are allowed at all before the age of 18. At 18, withdrawal follows sort of typical IRA rules. So the earnings portion taxes ordinary income if these use cases are met. So up to $10,000 of a home purchase, unlimited post-secondary educational expenses, and then up to $5,000 for the birth or adoption of a first child, all would be taxed as ordinary income. Any other use would be taxed as ordinary income plus a 10% penalty until age 59 and a half. So if child reaches 18, gets a job, needs a car to get to said job, they withdraw money from this account to pay for said car, they would be taxed income plus 10% because it's not an eligible use. So I think there's still a lot to be determined about whether, these savings accounts are sort of suitable for family contributions for low-income families. But what we do know is that many are eligible for contributions, again, either from the government or from philanthropy. And it's really important that our lowest income and marginalized families benefit from this policy. So we can go to the next slide. We ran a sort of basic simulation about what happens if everybody who files taxes opts in. Again, this is a fairly conservative estimate because we know some people will file and maybe not claim everything they're eligible for different reasons. But even in this estimate, about 7% of our lowest income families won't get these accounts and about 3% of the second lowest quintile. Again, a lot of that is explained by the fact that they are not required to file taxes. But that translates into about an $850 million in foregone federal benefits for our lowest income families. We can hop to the next slide. And we could think about this $850 million on top of, a federal tax system that typically fails to help families with low incomes in particular build wealth. So this is a chart from 2022 data that shows the percentage of each of these sort of standard deductions that go towards the different income quintiles. The top line here is that about 80% of the $300 billion in housing and retirement subsidies typically flow to the top 40% of earners. So this is really a case where we want to make sure that our lowest income families, again, who are typically left out of these wealth building tax subsidies, are able to benefit from this program. Next slide. I think this context is also important. Another reason why we want to make sure our low-income families can claim these dollars is that we know that a lot of them are not going to have the means to save themselves. So more than 1 in 4 families don't have $2,000 in emergency savings. On this map, the darker the color, the higher the percentage of families who do have savings. So you can see some real geographic differences here. This is not going to be surprising to any of you. But again, we want all families to be able to support their kids and for those kids to have resources when they turn 18. So this is an opportunity to just claim resources that are out there and available and let them grow over 18 years, again, tracked to index funds. We can hop to the next slide, which is our last slide. Here are some the things that we at Urban are still sort of thinking about. This piece about automatic enrollment. So Treasury does have the ability, though it's not required, to establish automatic enrollment. So this could look like, rather than having folks opt in via a form, we just use Social Security numbers to enroll people. This is something that's sort of best practice in the early wealth building space across state child development account programs. And certainly something that we are continuing to look at in terms of feasibility. It will be important for us all to be paying attention this year to enrollment rates via this tax form 4547 and see what kind of participation we see. We are aware that Treasury has announced that they've hit the million account milestone. So there definitely is engagement with this program. There's no current public plan to build up the accounts of the lowest income kids. So again, we've talked about philanthropic contributions, but it is a point that we would like to see the federal government thinking about some sort of progressivity year over year. Again, just recognizing the uh, lack of resources that some of our families are going to have to make their own contributions. The interfaces, I think this is a big part, especially for those of you working directly with families. We don't know because we don't know who is going to be managing these accounts in terms of which bank is going to be offering them. We don't know what the sort of app interface will look like, how folks are going to be able to track their balances. These are not centralized accounts with the government. They do have to be held privately. So something for us all to just sort of keep track of as those things get announced. And then I think the tax benefits for low-income families relative to sort of 529s or a high-yield savings account. I think certainly it's important, again, that everybody go claim the money that is available to their child. I think as we're thinking about where is sort of family's dollar best used, that's going to be a different conversation, I imagine, with families and their financial advisors wherever they find them. But I do think it's important for us all to be aware that, there is no sort of emergency exemption from these tax penalties right now with this program. So for families' own dollars, which again might be resource constrained, it is important to understand the sort of tax treatment of these different options. I'm going to pause. My email is on this last slide. I'm happy to take any questions now or in the chat, but thank you again for having me today.
Thank you, Madeline. That was so great and very, very informative. Thank you for breaking it down and giving us that zoomed out scope of what families are navigating right now and what household financial stability can evolve into with some of these new insights and the structure of Trump accounts. We would love to leave a little space for questions for Madeline. And then we'll move over to Nina. Thank you, Nina. But any questions while we have Madeline as we close out this segment of our session? Let's just double check in the chat.
One thing that I'll say about this, as we're waiting for questions, is we need to make really clear that many of the contributions into the 530A accounts are not with after-tax dollars. So that not only would you, when you take a withdrawal, if you don't use it for one of the few permitted purposes at age 18 as an IRA, you will not only have a 10% withdrawal penalty, but you will also have to pay tax on those funds that you're withdrawing. And that's very different from many of the other retirement accounts. So that goes into your decision about how you would deal with this. I see a question in the chat about will an ITIN be shared with DHS? I'll be addressing that in my conversation.
Well, if there are, as additional questions come up, we've got some space later. So Madeline, if you could stick around just in case, and we'll keep an eye on that Q&A as well. Well, Nina, I'm going to pass it to you in just a moment. But before I do, I wanted to share the opportunity with this group to help inform what comes next with Trump accounts. And at Prosperity Now, we are currently gathering insights from partners to help us better understand how child and youth savings readiness is showing up during filing season. This includes awareness, implementation questions, of which I'm sure there are many, and taxpayer engagement. And so right now we are running a field learning survey that asks for your input on some of these key topics, identifying some of these emerging trends and challenges around implementation, surfacing practical lessons from filing season, and just your work overall in terms of field readiness, helping us to inform what comes and what gets developed out of this initiative, future resources, field support, and an opportunity to elevate direct practitioner perspectives in broader conversations. So we would love to hear your voice added to this learning survey. And in just a moment, let me get this shared. You'll see another poll asking if you would like to participate. So if you're willing to take our very short 3 to 5 minute field learning survey. You can opt in directly via the poll that you see on the screen. If you want to receive a follow-up on the survey and participate, have your organization participate, we would really love to hear from you. A yes on this poll will connect with the email that you registered for this webinar with, and we will send you a unique survey link to complete this very short field learning survey to really amplify what comes next. So we are very, very grateful for your insights and wanted to amplify that in this moment. So thank you for helping to strengthen our collective learning across the board. And with that, I am very excited. I'll leave that poll up for just another moment as we transition into our final segment before we get into Q&A, taxpayer rights and protections during filing season. And we've heard a little bit from Nina, but I'm very excited to hear more from you, Nina. Nina is the executive director and founder of the Center for Taxpayer Rights. She also served as the National Taxpayer Advocate from 2001 to 2019, leading the IRS's Independent Taxpayer Advocate Service and shaping national taxpayer policy. Nina also founded the first low-income taxpayer clinic in the US and has had decades of experience representing taxpayers in disputes with the IRS. With that, I am very excited to pass the mic over to you, Nina. I'll take the slides down and we can just hear from you. Thank you so much for being here.
Thank you, Sarah, for having me. And I see in the chat somebody asking about sending information out to families, et cetera. And the center is working right now on a graphic novelette that's just focused on folks being discharged from maternity wards to get them to sign up for the $1,000. And we're also then building off of that little graphic novel to other pieces of information. And we'll be doing some infographics, and we'll share with Prosperity Now and your network those links when we have them up. Right now, it's kind of hard because we don't know a lot. And so, you don't want to get out misinformation. So I've got sort of the cautionary part of the conversation. What happens when you see problems, when your clients are coming in and bringing problems to you? And one thing I'd encourage everybody at VITAs and TCEs is really look at your intake question. I know that the VITA intake form, has a question about, did you get a notice from the IRS? Did you have a problem? But I really encourage you to craft your own so that you can identify folks that may have a problem from a past year. And that's not to create work for you, except for one step, which is that you would then refer that client to a low-income taxpayer clinic, either in your community or in that's co-located, that's serving your community, or you can refer them to the community, the Center for Taxpayer Rights. We actually maintain what I call a dating app for, nonprofits and a panel of volunteer lawyers, CPAs, and enrolled agents who can represent taxpayers before the IRS and before states. And you can sign up and become a part of our LITC Connect network. And then you just go online and submit a referral to us. And, and then we can try to find a volunteer representative who can help that taxpayer with a problem. So you can't help them if you don't ask the question. So that's really important. And I'm more than happy to work with you on that. So then the thing is, well, what kind of problems do people have? Well, listening about the paper checks just makes me, really nervous, because we all know no matter how much we push direct deposit, people are going to have paper checks. They're not going to be banked. If someone does not get their refund within 6 months of April 15th, when they've filed before April 15th, they filed by the due date, they can go to district court and file suit against the IRS to get that refund. And that paper check requirement is not anything in the law, so the court can order the IRS to make that payment. And so I really encourage you, if people haven't gotten it and you've heard back, again, that's another case where you could refer the taxpayer to a low-income taxpayer clinic to help them get that refund quickly. Other things you might see are refund offsets, from past tax debts. And you may not find out about this quick enough to be able to get an offset bypass of the refund, but you could definitely refer the taxpayer to a clinic so that that debt doesn't, if it's still there after the refund offset, that it doesn't come up the next year, that the clinic can help, either work out a payment plan, do an offer and compromise, maybe find out that the taxpayer doesn't owe this at all. So there are a lot of other issues. If someone gets a math error notice, saying we're disallowing a claim, that could be for any number of reasons. You might want to refer that taxpayer to a clinic. And I'm just going to sort of beat that drum. Now, when and how would you elevate systemic issues that you're seeing? Well, the Taxpayer Advocate Service has a function called SAMS, Systemic Advocacy Management System. And you can actually go on the Taxpayer Advocate website and just submit something that you're seeing that's a systemic issue. And theoretically, they're understaffed too, but theoretically, they look at it and they assign stuff to an analyst to see whether or not it is just a one-off or is it an issue that they should be exploring further. You can also talk to your constituent services member at your local congressional office or senatorial office, and that's not lobbying. You're seeing a problem in something working, and you're going to the constituent services worker and you're raising it to them, and they take a record and they really might just take that issue and work on it. So that's another really great resource that you can do. So I guess, I'll close by talking about the ITIN issue. The Center for Taxpayer Rights brought suit against Treasury, the IRS, DOJ, everybody under the sun, about statements about sharing in IRS return information, taxpayer return information across the board in the government. And in July, we amended our complaint because of the disclosures that IRS had received a request from ICE and was sharing information, address information with ICE. And as a result of our lawsuit in November, we got a stay, a preliminary equivalent of a preliminary injunction against the IRS from sharing any more information with ICE, and that they had to notify us if they received any more requests, et cetera. This past month, there was another lawsuit that was filed, I think in December, up in the District Court of Massachusetts. And that case included INS, or ICE as as a defendant. And that judge ordered a stay against ICE that they could not use any of the data that they had received from the IRS in any of their actions, including civil enforcement. And both judges found that it was a violation of the law that IRS had disclosed this information to ICE. This is being appealed. Our case is on appeal, so we're just waiting to see. But in both cases, those stays are in effect. So I can't say for sure it's not being shared, but where the IRS is under a court order to notify the court and notify us if they are sharing. So you'll be among the first to know if we find out any about that. I guess I'd say one more thing, and this is about because of the claims, the threat for ITIN holders who are not in the country with lawful status. ICE is taking a very aggressive position on criminal enforcement. And that means that if you're having conversations with them, your conversations are not protected by attorney-client privilege. There is no attorney-client privilege or return preparer privilege. And so, and the privilege for CPAs and enrolled agents under the Internal Revenue Code only apply to civil matters. So if you have someone that you're talking to and you get an inkling that maybe there's some risk for that person, again, get that person to an LITC, because then that attorney can help them have a conversation with them, and it is covered by attorney-client privilege. So that's just a really important point. I'll put my email address in the chat so you can all contact us if you have questions.
Thank you, Nina. That was really informative. And just to hear the resources that you're working on, the efforts that you're involved with to ensure these taxpayer protections. And I look forward to continuing for us to stay in this conversation to really allow for a tax opportunity network to benefit from all of the great work that Center for Taxpayer Rights is doing. I've got a lot of questions in the chat. So I actually thought we could bring all of our panelists back up on the virtual stage. And Rebecca, I know you've been looking at monitoring the Q&A, and we've got some chat questions that we've been answering along the way, but thought we could all jump back into fielding as many questions as we can. We've got a few minutes left, and I'll share some next steps from there.
All right. Apologies, the document's going in the background. So we've got a question. I want to start with Lynn. Hey, Lynn, has a question about whether or not there's a way to get the handout of the no tax on tips for her volunteers that she's working with for Get Your Refund. And so I want to say, yes, Lynn, there is a way to get that handout. We are working to actually post some resources to the files section of the Tax Roundtable listserv. So if you're on the listserv, they'll be there very shortly. And then Sarah Bacerra can share with us when they're going to be ready. Some additional resources will be ready in the Prosperity Action Network.
Exactly.
So in the next week, in the next week or so, when you receive the follow-up communication from this webinar, you will receive also links to access those resources in the Prosperity Action Network. And it's great to hear, Lynn, that you are on the listserv. I've answered a couple of questions already about overtime, so I'm going to go ahead and hit this one. Hey, Deborah. So yes, the answer is key what you see. So, and I think I answered another question as well. So what you're going to do is key what you see in box 14 for overtime. And then also there is another space in TaxSlayer for the Schedule 1A that will ask you actually specifically, there's a box specifically for overtime, and you're going to put that number in again there on Schedule 1A. And so I think that answers your question as well as Mike's question as well. I do want to check in with Ann to see if folks have been able to access the Prosperity Action Network. And maybe I'll just check in broadly to make sure, because we had a little bit of trouble with the chat coming in, but I want to make sure that everybody's able to access the Prosperity Action Network now. Way to go. Thank you so much, Sarah. The link's there in the chat for you again. Robert has a question about kitty tax. And I am going to refer you, Robert, to the group and the collection of experts that are on the listserv. And we may be able to get a response, a better answer, a more fulsome response for you around kitty tax. And you might be able to expound on your question a little bit more there. And now we're going to go back to Milan, and I'm going to turn it to Madeline to answer some questions about the Trump account.
And I saw yes, Madeline, I saw your clarification. So maybe Milan, as we're wrapping up, if there's any more specific detail that you can provide around what you're looking for, we can pass it over to Madeline. And I know if you are willing, panel, to drop your email in the chat for follow-up conversations and questions that we don't have time to get to in our last couple of minutes, that will be great. Luann asked a question about tips, and I know Deborah had a similar question in Q&A for overtime. So we can talk a little bit about the resources coming, Rebecca.
Yes. So we do have some resources that are coming that give some clear instructions. And thanks so much to our partners and the members of the TON Steering Committee, to J.C. Craig and Dave Szyminski and Courtney O'Reilly. And really the whole TON Steering Committee has really been working hard to develop and provide some resources for you all to make sure that you have like the step-by-step guidance that you need and that you can share, that your volunteers will need in order to actually prepare, high quality, accurate returns as always. So hang tight and we'll get those up for you. Hopefully by today, we can have them accessible for you in the listserv in the file section, and we'll provide some links for you there.
Sounds great. Thank you so much, everyone, for your great questions. Any that we didn't get to answer, got that contact information. We're going to share also our follow-up information as we're closing out, as we're having these conversations and just scratching the surface on some of these topics, but having our team of experts here as well.
Sarah, I'm not
Oh,
sure that our emails in the chat are going to the full chat. It only seems like they're going to host and panelists.
here, I'll
So
make
maybe you can share them with everybody.
yes. I see. Interesting. I'm gonna, if everyone can see when oops, I put Sarah twice. But are you able to see when I drop it into the chat with everyone?
Yeah.
Yes, we can see it when you
Okay.
drop it.
So, so fun and quirky, isn't it?
Yeah. And while
Uh,
you're doing that, I do see some questions around overtime. What we've been seeing has been like a lot of employers have although the requirement is there's not a requirement for them to report overtime on the W-2 as of this year. We've seen a lot of employers who have actually taken the steps to do that and provide that information. And I think Brian said in the chat or in the question somewhere that the last pay stubs are better. That's like a VITA thing. We've never actually taken the last pay stubs, and though this will be like the one time that is the only place where we can get the accurate information if the employer did not report that on the W-2.
Thanks, Rebecca. All right. Well, we are at time. I wanted to share some closing next steps as we move into what comes next. Wanted to share one overarching message as we close out our time together is that all of these policies and practices ultimately connect to something bigger, people's stories. Find every data point is a real person, family, or community navigating these complex systems. We have a campaign running right now called Stories of Prosperity. And through this effort, we're collecting short stories that reflect how tax time policies and programs actually show up in people's lives. The wins, the challenges, and also the turning points. So if you have a colleague, someone you've served, your own story, we'd love to share and amplify it. So visit storiesofprosperity.org to submit a short written reflection and have your organization amplified in this collective effort. A few next steps on staying connected. Everyone will receive a recording of today's session. So if you're missing these last couple minutes because it's 101, we will share what comes next, the links and key resources that have been shared throughout this session, and a way to stay connected to resources as they become available, many of them mentioned today, through the Prosperity Action Network platform. We are very very much looking forward to continuing this conversation and supporting your tax filing work throughout the season. My lovely, amazing panelists, thank you so much for being here today. We are so grateful for the work that you do and for the messages that you elevate in all of this to give us that real-time trusted information. Any questions come up around resources or next steps, please do feel free to reach out to programs@prosperitynow.org. And with that, I will say thank you all. Have a great filing season, and we will see you next time.